All right. In this video, we're going to be talking about revenue recognition and expense recognition. To do that, we're going to have another focus company. This focus company is going to be related to one of my favorite subjects. I'm a big fan of Star Wars. I like Jabba the Hutt. I like Ewoks. And you can't like Star Wars without liking lightsabers. This one doesn't work that well. Inside a lightsaber, you have a bunch of different components. The one that we're going to care about today are these things. These are what are called kyber crystals. And it's what makes the lightsaber work. So our focus company in this video is going to be Obi-Wan's kyber crystals. In the handouts that go with this video, you see Obi-Wan's kyber crystals up here at the top, and you see that we're going to be talking about revenue and expense recognition. We're going to look at revenue recognition principle, the expense recognition principle, the income statement and accrual accounting, and the financial statement ratio called net profit margin. The first thing we're going to do is look at revenue recognition. Now, revenue is the amount charged for goods and services. When is it recognized? Which basically means recorded in the journal. Now, according to the revenue recognition principle, in accounting, again, we follow generally accepted accounting principles, and this is one of the main ones. Revenue is to be recognized when it is earned. Keyword, earned. Now, what does that mean, to earn revenue? When a business has fulfilled its performance obligation to the customer, it has earned revenue. Now, what does that mean? That basically means when the business has done what it's supposed to do for its customer, it can record the fact that it has earned the revenues from that service. So we're going to look at some transactions here in a minute. The expense recognition principle. In order to provide goods and services to customers, businesses face operational costs related to wages, utilities, insurance, and a bunch of other stuff. Expenses are costs incurred to generate revenue. When are expenses recognized or recorded in the journal? According to the expense recognition principle, expenses are recognized when they are incurred. Well, what does it mean to incur an expense? Expenses are incurred when the activity leading to the cost happens. So we're going to look at some transactions here and see what we can do with them. So let's first look at revenue recognition principle and see if we can't journalize these transactions for Obi-Wan's kyber crystals. Now, in letter A, what happens? Obi-Wan collected $1,500 from customers for lightsaber repairs completed during the month. So, again, we have to answer those three questions. Number one, what accounts are affected? Number two, are they going up or down? And number three, is it a debit or a credit? So if Obi-Wan collected $1,500 from customers, what happens to our cash? Well, our cash is going to go up. And so we're going to have a debit to cash of $1,500. Using, again, the debit and credit rules that we looked at in the last video. But what else happens here? What do we credit? Well, the question is, has Obi-Wan done what he was supposed to do for his customers? Has he fulfilled his performance obligation? And yes, he did. He completed the repairs for the customers. And so he has earned revenue. And we get to record service revenue as a credit. Now, why is service revenue a credit? Well, that's a good question. To answer that question, we've got to go back to the accounting equation. Now, the accounting equation, assets equal liabilities plus equity, has certain rules for debits and credits. As we looked at before, assets are increased with the debit and decreased with the credit. So they have a balance on the debit side. Liabilities are increased with the credit, decreased with the debit, and so they have a balance on the credit side. Under equity, we actually have two things. We have common stock. Common stock represents the amount invested in the business by the owners, and it is a credit account as well. The other side of equity, the piece of equity, is retained earnings. Retained earnings, like common stock, increased with the credit and decreased with the debit, so the balance is on the credit side. And so, as we said in the previous video, if it's on the left side of the equation, it's on the left side of the account in terms of the balance. Right side of the equation, right side of the account in terms of the balance. Now, this isn't exactly going to hold true from here on out. And the reason being is that we're missing some accounts from this equation that we haven't discussed yet. Within retained earnings, we have revenue. It's a sub-account, if you will, of retained earnings. We have expenses. And we have dividends. Now, in terms of revenue, what does it do to retained earnings? Does earning revenue make my kept profits go up or down? Well, it makes it go up. How do you make retained earnings go up? With a credit. So revenue is a credit account. Why? Because it makes retained earnings go up. Expenses. What are they? What do they do to our kept profits? Well, expenses make our profits go down. And so they are a debit account because debits make retained earnings go down. And then dividends, the same thing. Dividends are a debit account. Didn't leave myself much room there, but dividends are a debit account because they are going to reduce the profits that are retained within the company. So, revenues, credits. Expenses, debits. That's pretty much the focus that we need to have right now. So, letter B. What happens here? Obi-Wan sent an invoice, or a bill, to Mace Windu for $400 lightsaber repair. It was completed on the last day of October. The bill will be paid in November. So what do we do here? What accounts are affected? Does Mace Windu owe Obi-Wan money? And the answer is yes. Why? Because Obi-Wan completed the repair on the last day of October. If I'm recording the journal entries for October, that should be reflected. And so I am going to debit accounts receivable because Obi-Wan needs to receive $400 from Mace Windu. Accounts receivable, again, or what we abbreviate sometimes as AR, shows or represents the amount our customers owe us. Now, what do we credit here? Well, Obi-Wan has completed the service the last day of October. Obi-Wan, in other words, fulfilled his performance obligation to Mace Windu October 31st. And so Obi-Wan gets to record service revenue for $400. Now, it doesn't matter that he hasn't gotten paid yet, right? Revenue is recorded when it is earned. And so we move on to the next one and take a look at it. Letter C. The Jedi Council gave Obi-Wan $5,000 check for services to be performed in November and December. So this is during the month of October. Obi-Wan receives this check, but the check is payment for services he has not performed yet. Services he will perform in the next 2 months. And so what do we do here? Well, we can't do nothing, right? So what do we know happens? Well, Obi-Wan received cash of $5,000. So his cash has gone up, which means a debit for cash. What do we credit here? Has he earned this money? Has he performed his obligation? No, he hasn't. And so we need to record the fact that he owes the council something. Whenever we owe other entities or people amounts, whether they be services, products, or money, we have a liability, right? And so we are going to credit an account called deferred revenue. Now, deferred revenue, just to be clear, is a liability account. Liabilities go up with a credit, right? Now, students often get this confused, and they mess this up because they see this word here, revenue, and they assume that's a revenue account. But it's not, right? It is a liability account. So no revenue is earned here. In letter D, Obi-Wan received payment of $300 from Kit Fisto for repair services that were performed in September. So back in September, the previous month, Obi-Wan performed a service for Kit Fisto. And now Kit Fisto is paying him. So again, the easiest thing to determine here is what happens to cash. Well, Obi-Wan's getting $300 extra in cash. Cash goes up, we debit cash. But what do we credit here? What do we credit for the $300? Are we going to credit revenue? Well, no, we shouldn't credit revenue because, again, these services were performed in September, last month, which means the revenue should have been recorded in September when the performance obligation was fulfilled. Now we're simply getting paid. So if we would have recorded this back in September, what would we have done? We would have recorded accounts receivable of $300 and service revenue of $300, right? That's what we would have done in September. Now we're getting paid. We're going to credit accounts receivable because Kit Fisto no longer owes us the money. So we need to get rid of the fact on our books that it says that he owes us. And so those are the 4 entries we'd make for these revenue entries. Now, not all of them required us to record revenue. We have different scenarios, but the issue is we have to apply the revenue recognition principle, meaning we have to record revenue only when it is earned. Now, with the expense recognition principle, similar idea, but different scenarios, right? We are going to record expenses when they are incurred. What does that mean? Well, it means, again, that the activity leading to the cost has happened. So let's look at letter E. Obi-Wan paid $600 to a mechanic for repairing his delivery vehicle. What accounts are affected here? Well, if he paid $600, what's happening to his cash? His cash is going down $600. In addition, we need a debit of $600. As we know, journal entries, debits have to equal credits. So, what do we debit here? The question is, do we have an expense? What activity led to the $600 cost? Well, the mechanic repairing his delivery vehicle. Did that happen during the month of October? Yes, it did. And so we are going to record repair expense. Sometimes we use repairs and maintenance expense as an account. But that is what we would record. And again, if you remember, expenses are a debit balance because they reduce our retained earnings, our equity. Now, if we look at letter F, a little different scenario. Obi-Wan received his October utility bill for $200. The bill will be paid in November. So we get the October utility bill in the mail. Tells us we've used $200 worth of utilities, but we're not going to pay it until the next month. So what do we record? Is cash affected? Well, no, our cash is not affected. We see that we are going to pay the bill later, meaning we owe money. So we are going to record a credit to accounts payable for $200. The debit is to what? What are we going to debit for this? Well, have we used the utilities during this month that led to the $200 charge? Yes. The $200 charge is for the October utilities. So when were the utilities consumed? They were consumed in October. And so we need to record the fact that we have utilities expense here for $200, even though we haven't paid the bill yet. Letter G is a little different scenario as well. Obi-Wan pays his September utility bill of $180. So we're in the month of October, and we're paying for the previous month's bill. What do? Is cash affected? Yes, it is. Our cash is going to go down by $180. So we're going to credit cash for $180. What do we debit? Are we going to debit utilities expense? Well, we shouldn't, because these utilities were from September, meaning we consumed these utilities in September, and they should have been expensed in September. And so what do we debit here? Well, if we look at the previous journal entry, when we record the expense, we recorded it as a payable. Now, in this scenario, we're paying off what we owed from the previous month. So we're going to debit accounts payable. So there's no expense in letter G. And finally, in letter H, Obi-Wan paid $6,000 for November, December, and January rent on his workshop. Well, cash is affected here. Our cash goes down by $6,000 if we paid someone $6,000. But what do we debit? Is this something I should record rent expense for? Well, it sounds like it. But what is the activity that leads to the $6,000 cost? The $6,000 cost is for Obi-Wan occupying his workshop in November, December, and January. Has he done that yet? Well, no, it's only October, right? He has not occupied his workshop for November, December, or January yet. So he does not have an expense. Well, what does he record instead? He records what is called prepaid rent. Prepaid rent is a form of what's called a prepaid expense, and it is an asset account. So when we pay for something in advance, we record an asset. Now eventually, does it need to turn into an expense? It does, but we'll get to that in the next video. So for revenue recognition and expense recognition, the key is making sure we understand the principles and applying them. Understanding them is the easy part. Revenue is recognized when it is earned. Expenses are recognized when they are incurred. Those are the principles. Applying them is much more challenging than memorizing the principles. So what happens next? Well, like we did before, the first thing we do is record stuff in the journal. Then, once we've recorded everything in the journal, we move it to the ledger. And that process is called posting. So we need to set up our ledger. To save some time, I'm going to do it for us real quick. Taking the balances in our accounts from the beginning of October and posting them in the T accounts in their correct column, whether it's debit or credit, based on the kind of account that it is, this is where we start. Now, we go to the posting process, and we simply take each journal entry and move it over into the ledger. Now, once we've moved everything into our ledger, then we can work to find the ending balances for the period. So these are our ending balances. And we take our ending balances where each account finishes the end of the period. Now, we want to make sure that we have done everything, at least to keep our accounting equation balanced, that we could do. And the way we check that, like we did previously, is to build a trial balance. Here's our trial balance for Obi-Wan's Kyber crystals. We've taken the balances in each of our accounts and we've moved them into a 2-column sheet here in financial statement order to see if our debits equal our credits. And if we do the math, it appears that they do. Now, again, does this mean we did everything correctly? No, it doesn't. But it does mean that our accounting equation is in balance. One other thing to reiterate is that this trial balance is not a financial statement. We talked about that before, but since it has debits and credits on it, it is not going to go out to external people. What does go out to external people? Well, once we're finished with our journal entries, posting to the ledger, and building our trial balance, then we can build the financial statements. So the first financial statement that we're going to build is the income statement. Now, the income statement shows us the profit for the business for whatever period of time we're recording or preparing it for. So in this case, we have Obi-Wan's Kyber crystals, the income statement for the month ended October 31st of 2025. Now, from our trial balance, we're going to look for what accounts. Well, for the income statement, we need revenues and expenses. Revenues and expenses are going to be the last accounts on my trial balance as I prepare it in financial statement order. Assets being first, liabilities, equity, revenue, and expenses. And so my service revenue of $1,900, can check that off. My repairs expense and utilities expenses, can check those off. My total expenses add up to $800, and my net income for the month is $1,100. And so we have a profit. Was our company profitable this month? Yes, it was. Once we've prepared our income statement, then we can move on to preparing the second financial statement, which is the statement of retained earnings. The retained earnings statement has the same time period as the income statement, for the month ended October 31st, 2025. The retained earnings statement is fairly simple. It starts with what did you have to begin with? Retained earnings, October 1. Our retained earnings from our trial balance here, $283,940 is what I started with. I have net income of $1,100. I didn't pay out any dividends, and so my kept earnings, kept profits, kept income accumulated up to the end of October 31, 2025 is $285,040. Now, when I go to build the balance sheet for October 31st, what number am I going to need? I'm going to need this one. So, what does the balance sheet look like? My balance sheet has a different date, right? It's just for October 31st. And on that date, what were the balances in all of my accounts? Well, I had cash, accounts receivable, and prepaid rent, which are all current assets. And then I had equipment, which is a non-current asset. So my total assets were $838,360. On the liability side, I had accounts payable and deferred revenue, which are both current liabilities. I have a note payable, which is long-term. And I have total liabilities of $53,320. And then under stockholders' equity, I have common stock. As we know, the amount invested by the owners. And I have retained earnings, the amount reinvested by the owners. My total stockholders' equity then is $785,040. And it shows when I add my liabilities and my total equity, I get the same amount as my assets. So my balance sheet is balanced. Now, the last thing that we're going to look at is a financial statement ratio. The financial statement ratios, again, are the way we compare businesses to themselves over time and to their competitors. The financial statement ratio we're going to look at here is related to the income statement. It is called net profit margin. And it's calculated by taking net income and dividing it by total revenue. And so in our case, we have net income of $1,100 and total revenue of $1,900. So if we do the math, we come up with 0.5789, and it keeps going. And so if we convert this to a percentage, which we normally do for net profit margin, we would get 57.89%. So what does this mean? This tells us that for every dollar that the company earned in revenue, for every revenue dollar, how much of that dollar made it down here into profit? Well, in this case, 58 cents if we wanted to round it. So 58 cents of every revenue dollar, every sales dollar, every dollar we earn by performing a good, performing a service or selling a good, resulted in 58 cents in profit. Now, question again, is this good or bad? Very difficult to answer that question with what we have in front of us. Now, it's good that they did not have a loss, that they had profits, but we don't know what they had in the previous month. We don't know what they had in the previous October. We don't know what their competitors are getting. And so it's hard to answer that question without really comparing it to something else. But we care about these two principles, revenue and expense recognition, because it allows us to see what Obi-Wan earned during the month of October and what costs they incurred during the month of October. If I'm going to compare his efforts, what he incurred in costs during the month of October, if I'm going to compare his efforts to his accomplishments, what he earned during the month of October, then I have to keep track of those things. And so, how do I keep track of what he earned and what he incurred? Well, I follow those two principles, revenue and expense recognition. These two principles if we are following these two principles, revenue and expense recognition, this is what is called accrual accounting. And it's what most businesses, especially big corporations, have to do. It's the type of accounting that they have to carry out.